everyone. It's Barry Knapp with Ironsides Macroeconomics. It's Monday morning, October 25th. I am indeed recording this on Monday morning. S&Ps are up a little less than 7 handles, but bond yields are up again as well, being led by the back end in the nominal space and in break-evens in the belly of the curve. So 5s and 10-year break-evens, which are pushing to all-time highs. Our note this week had 5 sections to it. The first section was titled Still Waiting for a Fat Pitch. That was an update to our near-term market outlook. This was an important change for us. Handcuffed is the title of the report, and that's really all about Fed policy. We also had an update to fiscal policy we titled Our Federalist Republic. We think on balance, we're headed towards a much better outcome than definitely could have been the case. We had a section on Bitcoin with the launch of the futures ETF and a bit of a discussion about the Bitcoin basis. That's the differential between underlying Bitcoin and the futures, where open interest is surging. And then we had a brief earnings update. We're going to clearly get quite a bit more in the on the earnings front this week. So beginning with still waiting for a fat pitch, last week was reflation in full force. We had commodities moving higher, reflation-related equity sectors moving higher. As I said, break-evens were pushing higher as well. We also had a very unusual circumstance where the market expectations of additional rate hikes and rate hikes coming sooner were pushing up at the same time that we had inflation break-evens widening. And that was the catalyst for our section on Fed policy titled Handcuffed. So I'll come back to that in a few minutes. But it now appears clear to us with this reflation surge being as strong as it is, the Fed being behind the curve, so to speak, and the budget outcome looking like it's going to be much better than we expected, that our correction call or call for a 10 to 12% correction is unlikely to unfold in 2021. We may very well get one out of the gate in 2022. We'll have to take another look as we get into December and through the positive seasonality, the so-called Santa rally. But we now think it's very unlikely that we will get a 10 to 12% correction and get anywhere near 4,100. That was the fat pitch we were looking for to re-engage after our call that we made in the summer, where we reduced exposure in small caps, materials, emerging market equities. Still wanted to be overweight industrials, but suggested taking some risk off the table there as well. That call did work reasonably well. Rates did move significantly higher, which was part of our forecast. We remained market weight, consumer discretionary tech, communication services, and underweight utilities, REITs and staples. Obviously, REITs have done pretty well. That's the only part of that call that didn't work. But we did decide to remain overweight financials and energy and upgraded healthcare. All of those worked out reasonably well. We still want to be invested like that, but we will look to add some exposure here to probably to industrials and materials on any weakness through earnings season. So we're going to have slightly more exposure than we did, but not go all in because we never got that fat pitch. We still think it makes sense to be somewhat more defensive as we transition to the middle of the business cycle. So that's it on the market call. Again, we don't think we're going to get down to 4,100 before the end of the year. We may very well get a bigger correction at the beginning of next year. We'll see how circumstances unfold as we push forward. But we would definitely stick with overweights in financials and energy, industrials, and really stay in the reflation theme through the balance of the year. So on to our section on monetary policy. We begin with a chart on U.S. and German inflation break-evens, which are pushing significantly higher. The Fed is, in essence, handcuffed themselves by their process. It's really process, policy, and politics. The process part of this is this idea that they need to slow the asset purchases over the course of 6 to 8 months. They're going to announce that obviously the week after next. Then they have to wait, make sure the market absorbs it, and then they can hike rates. All of this is a fairly lengthy process in a very different environment than we were in the 2010s. remember that they eased rates and policy in response to two supply shocks. This would be as if they were cutting rates massively during the OPEC embargoes in the 70s. It would have been bad policy then. It was bad policy now. The Fed argues that they shouldn't try and slow demand when it's all supply driven. Well, they tried to spur demand when it was supply driven, and they're spurring demand in the most interest sensitive parts of the economy, therefore exacerbating price pressures. So the Fed policy response was wrong, and doing nothing is not the way to fix bad policy. The broader policy section of this as well is this idea of average inflation targeting, but it's also what we would describe as inflexible transparency. When the Fed tightened aggressively in '94 in response to the prospect of higher inflation then, they even had a surprise 75 basis point rate hike. They ended that process, and we had an absolute investment boom that did drive productivity higher. During the 2004 to 06 transparent measured removal of policy accommodation, they triggered a housing boom that was ultimately destructive rather than productivity enhancing. It really impaired productivity for more than a decade. That was bad policy. And so the Fed has trapped themselves into this idea that they need to tell us every step of the way and give us plenty of heads up. It's just not the right way to be approaching capital markets and their policy. And then, of course, the politics will be the debt, and that will inhibit them, and that get us into another 60s-like scenario. On the fiscal policy front, the story is a little bit better. We'd start by, we titled the report Our Federalist Republic, and it was the idea that the checks and balances really did appears to be precluding the worst case scenarios. Remember that although Biden might fancy himself similar to LBJ, a transformative president, LBJ's majorities were 295 to 140 in the House and 68 to 32 in the Senate. He didn't need everybody's support in order to push through his war on poverty, the introduction of Medicare and Medicaid. He didn't need help from the Republicans. He needed that on the Civil Rights Act, but he didn't need it on his spending policies. Biden's majority obviously is the narrowest majority that a president has ever had. And it appears that, as I said, some of the worst case scenarios are off the table. Drug price controls look like they'll be far more benign than we expected. The disruptive clean energy policy is likely to be much less disruptive. And it's now looking like that the corporate tax hikes and capital gains tax hikes that were on the table are essentially coming off the table. So this looks like it's going to be a much better outcome. We are still set up for a reflationary scenario, like we've speculated or forecasted, that we will have a scenario very similar to the 60s where reflation drives higher, and we do have unsustainable debt that ultimately the government will try and monetize. But it precludes a scenario where under the Bernie budget, we could have skipped straight to the 70s, caused an absolute boom, and then subsequent inflationary bust. So that's it on the fiscal policy outlook. Obviously, as the details come together, we'll have more to say on that, but there's quite a bit in the note as well. Moving on to the introduction of Bitcoin futures-based ETFs. We wrote a bit about that Bitcoin basis, the trading between cash and the futures. Futures open interest obviously is growing sharply with the introduction of these ETFs. The one garnered 1.1 billion in assets over the course of the first 2 days. This is going to make futures trading much more liquid. That requires arbitrage trading, very much like stock index futures back in the 80s. It will bring more liquidity into the underlying. It'll bring more liquidity into the futures. It is a good thing on balance, but it will make for some instability at times, and we could have the basis go negative and have a crash-like scenario. Wouldn't shock us to have something like the crash of '87 happen in Bitcoin. We also wrote a little bit about DeFi in the note as well, but we're going to keep that in the note and not include it in this podcast and video. Please be a subscriber to see all those details. And then on earnings season, 23% of the companies had reported as of Friday when we wrote this note. Earnings are tracking up 46% year on year on 16% revenue growth. Obviously, those are exceptionally high numbers. It's still comparisons to the pandemic. The net surprise is 13% on earnings and 2% on revenues. Again, pretty good numbers. The market reaction, as we thought, would be somewhat asymmetric, where beats wouldn't get that big a response, but misses definitely would. The average financial rallied 84 basis points on the day that earnings were reported. That's better than we expected. We talked about that a little bit last week, but we did expect tech to react generally negative to results. And the average tech stock as of Friday was down 240 basis points on the day it reported earnings. The average industrial was down 76 basis points, but those industrials were primarily industrial service companies. That was transportation and logistics. We're more interested in beneficiaries of capital investment, industrial goods makers. Those will be reporting en masse this week, so we'll see how those go. And if we do get weakness, as we said, we'll look to add to those on any weakness that unfolds. So that's it for me this week. Barry Knapp, Ironsides Macro. If you're not already a subscriber to our written research, we'd love you to become one. If you're an institutional investor with a voting system, please consider onboarding us and getting full institutional coverage. And finally, if you're someone who pays for research with commissions, you can inquire about our advisory relationship with Macro Risk Advisors. Barry Knapp, Ironsides Macro. Have a good week, everyone. Thank you.